The Invesco QQQ ETF is one of the very best ETFs for the long term that you can buy if you mainly want to aim for higher returns. However, there are significant and important caveats regarding the Invesco QQQ ETF that we will discuss in this analysis. First, a few standard statistics. The total expense ratio is relatively cheap at 0.2%. So, by the way, one of the largest ETFs with 300 billion in market value in this fund. So the issuer Invesco makes a lot of money from this ETF, but it has also achieved high returns for its clients in recent years. For example, the 10-year return is really quite high for an index fund. It's not really an index, but it is an ETF with 100 holdings, specifically in technology and innovation, and annual returns. This year it was 38%. However, we will see in the coming period that the QQQ ETF will not achieve such high returns. Over the past 10 years, this was a plus of 400% return. Just to compare in perspective, the S&P 500 has achieved a 220% return in the same period. And the Vanguard Total World Stock, also one of the best long-term ETFs and also cheap for passive investors, achieved only 100%. So with this ETF, you would have doubled your investment in 10 years. With the S&P 500 ETF, you would have tripled your investment. And I must say, tripled, of course. And the Invesco QQQ would have multiplied your wealth by 5 in 10 years. So that is demonstrably and significantly better returns, and really much more return than, yes, maybe 95% of all investment funds and all value investors that exist. And all that with simply passive investing in an ETF that tracks hundreds of the largest, most important, innovative companies in the world. However, the largest companies are almost all from the USA, so there is geographical risk. However, the problem with Invesco QQQ is not so much geographical risk, but mainly the risk of volatility and valuations. Even today, the valuation for QQQ is again very high. More on that shortly. The holdings, you see it, the largest holdings, of which the top 10 accounts for 51% of the total weighting. So that also means concentration risk in this case. This means, for example, that if Apple were to have, for whatever reason, then with 8% of the total weighting, it would naturally have a large impact on this ETF. Fortunately, there is sufficient diversification in other large companies like Nvidia, Microsoft, Meta Platforms, Tesla, Alphabet, and it is actually just a very simple way for a beginner investor to invest in the best companies in the world, but in a diversified manner. You can easily apply this with buy the dip to increase your returns by lowering your average purchase price in the long term should you have a poor entry point. 60% of all those stocks come from the technology sector in a formal sense, but other sectors are also represented in this ETF. And there are a number of interesting characteristics. The annual return is simply very high compared to other ETFs. For example, the 5-year return is 150%, while that of the S&P 500 was 100%. So the 5-year return is significantly higher as well. And this year was also quite a good year with a 30% return in just 1 year. However, the valuations have risen very high. More on that later. The expense ratio of 0.2% is relatively low, especially compared to the median. Other characteristics, such as dividends. Well, the ETF scores high on dividend growth, but it is not a dividend ETF, of course. So the dividend yield is very low. And if you are looking for dividend income, you are better off choosing a dividend ETF or what we prefer, putting together your own dividend portfolio. Then you can choose companies that consistently pay high dividends and can also provide price potential. The risk of QQQ is somewhat on the higher side. But what is risk? The risk is, of course, permanent loss of money. And from that perspective, it is not too bad for the very long term. However, for the short term, or perhaps even in the next 5 years, there is indeed a risk that QQQ has too high a fundamental valuation. But that is not included in what we see here. What we see here is the standard deviation, in other words, standard fluctuations, and also the annual volatility. And you can see that the annual volatility is somewhat higher than most ETFs. For example, the S&P 500 has an annual volatility of 12%, while the QQQ has 17%, which means it rises and falls with more fluctuations, and we will see that shortly in a closer look at the price chart. We also see that the turnover ratio is 22%, which means that 22% of the shares are switched every year. That is indeed somewhat on the higher side. Finally, the liquidity is very high, one of the largest funds in the world. The daily trading volume is 30 million. So even with larger portfolios, you can sell your portfolio or all your positions in QQQ in one day if you want. If you have a lot of money, then it becomes an issue. The QQQ has risen a lot. In 2021, growth stocks were overvalued, strongly overvalued. And as always, over the past 100 years, when market valuations rise too high, a correction occurs. In this case, it was minus 33%, quite significant. And you can also see that since then, the QQQ ETF has increased by 85%. From time to time, you can profit extremely from this higher volatility. Volatility is another word for price fluctuations. What matters, of course, is that the fund rises in the long term. Well, you see, the fund has risen in the long term, but nowadays, here at this peak, at the end of 2024, the valuation is indeed very high. These are great companies, Apple, Nvidia, Microsoft, but the PE ratio is typically above 30, and it seems that no account is taken of what if the next few years turn out to be disappointing economically. Yes, then you get a situation like the Dotcom crisis, but the Dotcom crisis was a very different kind of situation. Here you had companies like Yahoo. Yes, the valuations were sky high and those companies barely made a profit. So the situation was more extreme, and after the dot-com crisis, stocks also fell by 80-90%, extremely much. You also see that for years the ETF actually generated no returns. From 2002 to about, let's say, 2010, the return was actually negligible and even limited. And that situation occurs when the economic climate is interesting for a long time, favorable for investing a lot of money. Well, in the past, since actually 2015, 2016, inflation has been relatively low or even decreased, and interest rates have continuously fallen. Of course, with a low point around 2018, 2020, and interest rates are still relatively low but have increased. And what happens? The debt cycle or monetary policy has been relatively very smooth over the past period. So a lot of money is being printed, money is easily borrowed, and it all comes back into the market, causing valuations to rise, and continue to rise simply because there is enough money, and it may well be that Invesco will decline for a very long term, or even remain horizontal, but no one knows for sure. So that's always a thing with investing in thematic ETFs, in this case Invesco QQQ. When valuations rise very sharply, as in this case for the QQQ, you need to be careful with that. Where do you see all that? You can download the fact sheet, which you can simply open and view data in. And often you also first see just the summary of the standard situations. You also see that the return on equity is relatively high at 42%. However, you see that the price to earnings ratio is 37. 37 historically is quite high. It is partly compensated by the great company with the high return on equity. However, it may very well be that the economy does not decline as quickly in the next 5 years. Rises, and if the economy does not rise quickly, then that means higher valuations will be punished with a correction. So that is the question at the moment. We can't say much yet. Time will tell. And one thing we know for sure, look at the long term. And in the long term, QQQ is one of the better ETFs. So the best way to start, and the best is in parentheses because that obviously depends on how much money you have, but let's say you are just looking at the market and you have relatively little money and you want to achieve potentially high returns, then the QQ ETF could simply be one of the better ways for passive investing in fast-growing companies. And what you can do, since you have relatively little money, is just start with a monthly contribution and buy when the price drops, buy when the price rises. But when the price drops significantly, and for example, a 30% drop occurs quite often for these types of ETFs, then buy a lot when it has dropped by, say, 20 or 30%. And keep buying more during the decline. What you should not do is sell in a panic. You should actually buy more. It's actually that simple. And even if this is the highest level ever for the next 5 years, the price will decline for a long time. Then buy more, so your average purchase price becomes relatively cheaper. And what you should do then is hope that the economy will grow in the long term, but that is something that is beyond your control. What is within your control is to buy when prices drop. That increases the chance of success. If you have a lot of money, more money, then you can be a bit more cautious. Maybe start with a small weekly investment or just wait completely. And if the price drops significantly, then you can invest a lot of money. This is also called a lump sum, where you invest everything at once. And I simply don't think that by the end of 2024, this is the right time, given the high valuations, to invest all your money now in a higher risk ETF like the Invesco QQQ. What I would personally do in that case is look at ETFs or individual stocks with relatively lower valuations that are undervalued. So lower valuation, potentially higher dividend, and also a lower potential downside risk. In other words, applying value, buying undervalued stocks. Overall, Invesco QQQ does seem a bit overvalued at the moment.